And global stocks enter 2026 with record low cash and minimum hedging. But a slew of most crowded trade are now misfiring on Wall Street, with AI disruption fears cascading through markets. AI was supposed to be the can't-miss trade. Instead, it became the threat. And the worries are not to the companies building it, but to the asset-light businesses it could replace. Now, last week sent shockwaves through various asset classes. The dollar managed to take out some small gain in a widely gyrating trade week. The pain didn't stop at stocks. Crude ended the week 0.5% lower. Gold whipsawed, briefly dipping below $5,000 an ounce on Thursday before recovering to end the week above that level. Now, silver swung 11% in a single session. Bitcoin still nearly half off its October high, briefly sank below $66,000 before recovering slightly. Now, with major assets covered, let's shift focus to the Asia-Pacific stock markets. The biggest landslide win in post-war history has given Japan's Prime Minister Sanae Takaichi a huge mandate to revitalize the economy. That was reflected in Japan's Nikkei being the biggest gainer in Asia. The OC benchmark ended with a 0.5% rise. And on the other hand, Chinese and Indian stocks fell last week. In the Americas, the S&P 500 marked its worst stretch since November before Friday's rebound on a benign inflation print. But for now, the sell-off in AI is yet to turn into sustained market meltdowns, with the S&P 500 hovering near all-time high. Still, investor angst resurfaced last week as the threat of AI disruptions claimed new casualties in the stock market almost daily. Tech-heavy Nasdaq index crashed 3% for the week. However, Canadian and Brazilian stocks defied a broader sell-off to edge slightly higher for the week. And looking across the Atlantic, the UK's FTSE gained 0.6% last week as it became the fastest-growing G7 economy in Europe, despite sluggish growth. Other European stocks, though, reflected the gloom on Wall Street, although the declines were comparatively smaller in Europe. German and French stocks ended the week in the red. Well, having looked at market moves, let's now turn to the overall economic outlook. First, let's take a look at Asia. India remains the best performing major economy in the world despite Trump's tariff rhetoric. The Reserve Bank of India upgraded its growth outlook after the latest trade deals with the EU and the US. However, for several other countries in the region, the uncertainty from US trade policies are weighing on the growth outlook. In addition, China continues to battle a property recession and a deep deflation from weak demand. Changing Japan-China dynamics is also weighing on the outlook. And in the Americas, mixed messages on the macro front clearly reflect a clouded outlook. Job growth in the U.S. has stalled, with some indicators flashing a warning sign. At the same time, inflation remains benign to give the Federal Reserve more room to cut rates. Big Wall Street banks caution that stagflation risks are on the rise, even as inflation does not reflect the much-feared tariff impact. Trump's trade rhetoric extended to other economies in the region. In Europe, the standard norm across the region is muted economic environment. Europe's growth engine, Germany, is struggling to get its manufacturing activity back on track. GDP in the UK just about showed some growth in the final months of 2025, and that comes after GDP contracted for the second straight month in October, with no growth seen since June. In addition to those concerns, Trump's trade brinksmanship is hurting the economic outlook for the region.